Welcome to the Lend Academy podcast, episode number 31. This is your host, Peter Renton, founder of Lend Academy. On this edition of the podcast, we have a very special guest, someone that I've been trying to get on the show now for several months, but luckily the stars aligned and we were able to get our calendars all sorted today. And I am very pleased to have Aaron Vermut, the CEO of Prosper, on the podcast. And in this interview, we talk a little bit about the history of Prosper and about history of his involvement with Prosper and what those early days were like. But we then bring it forward to today and some of the recent developments that have happened. We discuss some of those in depth and also move on to the future, get some idea about, who Prosper is trying to be and what their plans are for the future. Hope you enjoy the show. Welcome to the podcast, Aaron.
Thank you, Peter. Happy to be here.
Okay, let's kick it off with just letting the listeners know a bit about your background and what you did before you came to Prosper.
Absolutely. So I graduated from college in 1995. I went to Washington University in St. Louis, majored in history and German language and literature, which was the perfect precursor for what I did next, which was I came out to California and I got a job in technology consulting.
Right.
The non sequitur there is I actually started as a technical writer for a consulting firm, and then transitioned into what's traditionally known as a product role within the technology consulting organization, working through specs and designing systems for, large MIS and data warehousing integration. So it's really exciting stuff. I did that for 3.5 years here out in California, and also in Switzerland, actually, for Cambridge Technology Partners. 1998 to 2000, I went to Wharton. I got my MBA in finance and entrepreneurship. Mm-hmm. And after I graduated from Wharton in 2000, I moved to Washington, D.C., where I got a job with New Enterprise Associates, which is a very large early-stage venture capital firm that exists, both on the East Coast and in Silicon Valley. It's actually one of the oldest venture firms in the country. And I worked for the managing general partner of NEA for 3.5 years, on the investing staff, making wireless and software infrastructure investments with that team. And I was a principal in that organization. In late 2003, I actually left NEA, moved to California, and started my own thing with my father, Steve, who I think many of your listeners are aware of as my partner here at Prosper. Uh-huh. And we started a company called Merlin Securities. We started the company in 2004 here in California and in New York simultaneously. Our CTO was in New York. And we built, a broker-dealer servicing small and medium hedge funds with high-end technology reporting, back-office services, and trading. We sort of spent the first part of 2004 building technology and broker-dealer and servicing and infrastructure. Peter, as you know, from when you start a new business, all that stuff takes a little time to set up. Mm-hmm. And then we did our first revenue-generating stub year in 2005, and we ran that business from 2005 until 2012. So 2011 was our last full year in business. And by the way, Ron Suber joined us in that endeavor in 2008, in April 2008. So that's the third leg of the stool in the partnership with Prosper. Mm-hmm. In April of 2012, we signed a definitive deal to sell that business to Wells Fargo. It actually became what is today the Wells Fargo Prime Services business in Wells Fargo Securities. And then we closed that deal in August of 2012. And then the entire business went over and became part of Wells Fargo, where Steve, Ron, and I kind of, we worked for a little while before coming to Prosper.
Right. So then, while you're working at Merlin, obviously, when did peer-to-peer lending first get on your radar? And was it through Ron, or did you discover it independently? How did it happen?
Yeah, well, I definitely came to the space relatively late, and it was through Ron. When we were running Merlin, I'm a usually very focused on the business that I'm running or I'm working on. And, I didn't really pick up my head and look around until after the business was sold. And it was the fall of 2012 when Ron, basically said to me, hey, this peer-to-peer lending thing is really interesting. He had been investing on both platforms for a number of years, thousands of loans, and, was just a general peer-to-peer lending enthusiast. And, he basically, encouraged Steve and I to take a look. And then we met some people involved in the business and started getting engaged, probably October, November, December of 2012.
Mm-hmm. So what attracted you to, what was the challenge? What was the reason that you decided to really, do this kind of takeover of Prosper, shall we say?
Yeah, so it's a really interesting story, and there's probably a longer form book in here somewhere. But when we started looking at Prosper, the company was really at a real decision point in its history. Chris Larson had been gone since March. We're looking at it in October, November the same year. The business had somewhat flatlined. It had, legal problems in the form of the class action lawsuit. It did not have a coherent strategy going forward or even a permanent management team. I mean, there was an interim CEO running the company on a couple days a week basis. So when we looked at it, there was definitely, it was a moment in time, and I think there was a round of financing that was trying to come together, which had, frankly, I think had fallen apart. And so when we got engaged, we met with Excel and Jim Breyer and John Locke, the guys who were managing the investment for Excel. And they basically wanted Steve, Ron, and I to become investors in the business. We are not professional investors, we're professional managers. And we started taking a look under the hood, under the auspices of doing an investment in the company. And, just came very quickly we came to the conclusion that this was a very interesting business in a fast-growing space with a very large addressable market. There was a unknown liability surrounding the class action lawsuit. There was unknown technical debt in the company. How much investment had been made in technology, how well did the platform work, how scalable was it, and there were just cultural and structural issues within the company that we could try to assess, but would never really get all the way to understand the risks within the time allotted to close an investment, because the company really needed to close a deal. So, but we were very attracted at the same time by the market size, by the business model, by the disruptive nature of what the company was trying to do, and frankly, the opportunity to take something that was, fundamentally a great idea, but just not executing well and try to fix it. Mm-hmm. And so we kind of closed our eyes and held our noses and jumped right in. I mean, there were a lot of things about the company that we just didn't know when we put the money in and got engaged. And so when we got here in, I guess it's 2 years ago last week, mm-hmm. We had to, just start going through the contracts and the bills and the customers and the business model and the, liability related to the class action lawsuit, and just start figuring it out. And, I'll tell you, Peter, that in the beginning, we were going through investment, all the way through to the time when the deal closed, there was no certainty that we were going to do it. I mean, we didn't just jump in here, enthusiastically saying, this looks like a great opportunity. Let's just go take it over and fix it. There were, we were certainly aware of some of the significant risks and trying to keep our eyes open about what we were going to have to do over the coming years.
Right. I know. I mean, I'm chatting with Ron Suber at length about it, and the deal almost didn't come together too. From what I gather, it was very much a.
Well, there was some contention between us and the board about the structure of the deal, mm-hmm. But also, Ron and I needed some convincing as well. I mean, there was enough, in the parlance of venture capital, there was enough hair on this deal that it made it look pretty risky.
Right.
But at the end of the day, we had a great partner in Sequoia. We feel like we have a pretty good team, and we were putting in a limited amount of money into the company. So we kind of understood the limited nature of the downside, and paired that off with, hopefully the large nature of the upside if we didn't break the thing when we were trying to fix it. And frankly, we weren't tied up at Wells Fargo and didn't really know what to do with the rest of our careers anyway. So it was sort of one of those things where we said, look, this is something where there's a large upside for a limited downside. Let's take a chance and go for it.
So then at what point did you realize, okay, great, this is a rocket ship that we've got here, and we're gonna really launch it? I mean, when did you sort of go from thinking, wow, I hope this is working, to, oh my God, this is amazing?
Right. Well, from day one, we knew that we were going to try to go big or just break it trying. Some of the key moments for us were, the first 6 months were the hardest. When we got here, we didn't even know if the business model worked. We didn't know, what we'd inherited from a technology standpoint. And we certainly needed to deal with the class action lawsuit because it was just a giant wet blanket that was thrown over the prospects of the company from many perspectives until we could get that settled, from retail and institutional and everything. It was just this thing that was out there, and the class had been certified, and we were potentially going to trial in October of 2013. Mm-hmm. But the court had basically mandated that we all get together and try one more time at a negotiated session to try to work things out. And so the day we went and did that, and the day that we went in there and we settled the lawsuit, that was a very big moment for the company, and definitely freed us up to start thinking about the future. We certainly didn't want to spend the next 5 years of our lives tied up in litigation with a certified class. And we, even though it was a $10 million settlement over 4 years, we figured while that was a large number in the context of where the company was at the time, it either was going to matter or it wasn't. And if we could grow, then it wouldn't matter as much. And if we couldn't handle it, then the company was probably going to go out of business anyway.
Right.
So, but it needed that chance to succeed. And so that was a really big moment for us. In the first 6 months, and if you look at the filings, Peter, you'll see us growing from $9 or $10 million a month of originations to 15 to 21 to 27 to 33. And when we get up to about 33 million originations, we are losing more money than we had been losing at $10 million originations, which means that we had some pretty fundamental problems
right.
In the model, right? So we were marketing more, doing more business, losing more money. That's actually not the way it's supposed to work. Mm-hmm. So over the summer of 2013, we made a number of changes to the platform. We rewrote the borrower funnel. We put in right when we started at the company, we had put in the new credit model that Josh Chandri, our chief risk officer, had been working on. But we changed our data source from ScoreX, which is primarily a subprime scoring service, to FICO 08, so that we could better match our customers' expectations of their, for their good credit of what they should get as a rate. And we lowered our prices to match what we saw out there in the industry as a whole. And so the real big moment for Prosper was in August of 2013 when we released those three things, so the new funnel, the new pricing, and the new data source. And if you look at the fourth quarter of 2013, you'll actually see originations start to rise again from 35 to 67, I believe, by the end of 2013. And if you look at the filing for the fourth quarter of 2013, you will actually see originations going up. We're still losing money, but losses actually start to come down, mm-hmm. which is what a healthy business is actually supposed to do. And we started making money on a contribution basis on loans that we were marketing to. So we send out marketing, we spend a certain amount on marketing, we do more money in revenue than we spend on marketing, and then that contribution margin from the loan starts to pay for the overhead of the business. And we figured, okay, now we actually have a business model that's working here, and we can try to, really now execute and go bigger and achieve scale so that contribution will actually start paying for the overhead in the business, and we can either break even or make money or reinvest in the business or whatever we want to do with it.
Right. And so that obviously those things you put in place there, it drove the growth in 2013, the fourth quarter, but like 2014 has, the numbers are obviously in the books now, and it was, a staggering growth, going to like 1.6 billion from 300 odd million the previous year. So when you're asked about this, what do you say? What are the key drivers of that astounding growth you achieved in 2014?
Right. So the key drivers, there were a number of things, but we fundamentally rebuilt sort of the partnership borrower acquisition model at Prosper. So whereas I think in late 13, if you look at our acquisition mix, we were like 80% direct mail, direct response on an acquisition basis. And if you look at the mix at the end of 2014, we're about 40% direct mail, 40% partnerships, and then 20%, kind of all the other stuff like SEO and pay-per-click and direct-to-site. Mm-hmm. And so we started going out there. We started working with the Lending Trees and Credit Karmas and Bankrates and other partners and building out affiliate programs so that we had a diversity of channels to acquire customers. And at the same time, we continued to hone down on the things that we needed to do well in order to increase that contribution margin and make money on the loans when they come in. So, streamlined funnel, highly efficient verification process, better customer service. We, in 2014, we expanded our customer service. We have over 130 people in a call center in Texas handling inbound customer service calls. We also opened, a facility in Phoenix to handle our underwriting and verification work. It's about a 20,000 square foot facility. About 60% of all of our verification processing now happens in Phoenix, and that's a much more cost-effective way than just trying to do it in downtown San Francisco. Mm-hmm. And frankly, the talent is there. I mean, if you think about all the people who lost their jobs at the end of the last cycle who were working in mortgage underwriting from Bank of America and Countrywide and Wells Fargo and all these other people, there's all this skill set for exactly what we need to do in terms of underwriting verification resident in Phoenix at a cost-effective basis. So we started building that out in Phoenix. We just got better and better at drilling down into aspects of our credit model, our acquisition model, our verification model. So a lot of that growth was basically done on the same number of sort of targeted users and unique visitors to the site. We just learned how to convert those people into loans better. So conversion is really a key word around here, conversion, in a cost-effective manner. And then one of the things that really sort of turned the dial for us in the year was we released the 5th generation of our proprietary credit model. We call it PMI 5, Prosper Marketplace Inc. 5. And it actually, really increased our ability to target borrowers, to identify those good borrowers who have a high likelihood to pay back, and to identify or to better identify either fraudulent borrowers or potential borrowers or people who are less likely to pay back. So we could avoid the bad and lend more money to the good. And that produced a 40% increase in our marketing efficiency right there by targeting our customers better. So, if you look at the quality of the loans that we've been issuing over the last year, as we grew from, as you said, 369 million in loans originated in 2013 to 1.6 billion in 14, verified by third parties like PeerCube, the loan quality is actually getting better.
Right. Yep. No, I've seen that from a variety of sources. So, and just one other thing about the growth. I mean, you're driving down your acquisition costs per borrower. I mean, so is that still, are you still improving on that? Like, did you have goals for Q1 of 2015 to keep driving that cost down? I mean, there's got to be a point where it's going to be difficult to drive it down much further.
Well, it's interesting. We want to drive it down, but not at the cost of growth. We want to make sure it is reasonable within the models, that we have good contribution margin and we can continue to reinvest in the business. But we don't want to squeeze our partners. We really want to focus on being able to better monetize the traffic that's coming to us, rather than trying to go back out to our partners and saying, we need to pay you less, right? So we're still investing in those channels. We're investing in our growth. There's a really great flywheel effect that you get by investing in your partners. If you pay your partners on a success basis, and a lot of the work that we do with our partners is they basically make like a revenue share on a loan if they refer a qualified borrower over to us, but they have to actually take the loan. And the more business you're able to convert at higher dollars, the more revenue you can share with the partner. the partner makes more money. If a partner is making more money off of the relationship, they are able to spend more on placement and targeting and advertising for you on their site. And that which means you get actually more referrals, and so you get this sort of wonderful flywheel of digital commerce where the more business we're able to do, the happier they are, the more business they send us. And so we want to make sure those partners are happy, able to invest in the relationship with us. So it's a balance. And when you're running a business like this, there's only sort of three ways to approach marketing. You can really dial back, because when you target, Peter, you can basically say, here's where my maximum return is on a marketing spend. And you can look at the response rates, and they sort of tail off the deeper you mail or the deeper you market into a segment. And so you could say we could go for maximum profit. We can go for, that's one way. You can go for sort of, go for the last profitable loan. So where marginal revenue equals zero, or marginal profit equals zero, so of the marginal cost. So you have basically you mail as deep as possible without wasting money. Or you can just go and mail everybody and waste money and try to grab market share. We tend to be that focus on that middle methodology, which is we want to mail and we want to market to borrowers as deep as possible so we get that last loan that's profitable, but we don't want to waste money at it. So we're still, which is why you see us running basically a break-even business. We're investing in channels, we're investing in marketing, we're going after that sort of last loan, but not trying to waste money doing it.
Right. Okay. So let's move over to the other side of your business, the investor side. And, obviously, it's no secret that you guys have done an amazing job of pulling in, some large institutional investors onto your platform. Some of the biggest names in finance are investing in loans on Prosper. So I wanted us to talk about the retail investor. And, obviously, the demand is insatiable in some ways from these institutional investors. And, the retail investor demand seems like it's not growing dramatically. Can you just talk a bit about what your plans are for the retail investor and what you're intending to do to sort of make that, give it a bit more of a balance between the institutional and retail?
Sure, absolutely. So I'm going to go back a little bit and just talk about when we first got here. One of the things you have to make sure of is when you're going to go out and spend literally millions of dollars on borrower campaigns, the one thing you really want to be sure of when you're trying to start one of these platforms from a standstill is to make sure that you have that investor capacity to fund those loans. Mm-hmm. Because if you bring on a bunch of borrowers and they list loans and they don't get funded, you have basically created a really poor customer service experience, a customer experience for the borrowers, and generated no revenue, wasted a bunch of marketing dollars, and had all this fruit die on the vine. And so very early on, we basically brought on these anchor tenants in terms of some of these institutional investors so we could have that core, so we would know that if we went out and spent all this money on marketing campaigns, we could fund the loans and we could continue to learn more about our business, which is, again, back to what we learned in the first 6 months of being here. If we hadn't had some of those institutional guys, if we were doing about $9 million a month with retail at the time and we wanted to grow to 30, it's very hard to grow retail predictably, and it's really hard to go on a one-to-one basis on a marketing level with retail. And so we wanted to make sure that we could prove out the borrower side of the model and the business model first, and that's why the institutional guys were so critical in the very beginning. So that being said, we are totally committed to retail here. I know we get a lot of flack for having a lot of institutional investors on the platform. Frankly, they grow faster than retail because they show up with millions of dollars instead of thousands of dollars. But we maintain a very heavy legal compliance accounting function here, which is state by state compliance, SEC compliance, public filings, S1s on every loan we fractionalize, bankruptcy remote structure, which is the only bankruptcy remote structure in the industry that actually also applies to retail. All of this is an investment in the retail platform, and all of it is an investment that we're going to continue to make. And we really feel like, I personally really feel like that the growth and the health of the retail side of the business is how we build a 100-year company here. If and when that there is a change in the cycle, rates change, investment profiles change, the big guys are yield chasers and they could represent fast money. I think some of them will be around for a long time. I think some of them will go away. Certainly the dynamic on the platform will change. And that's where retail will be so important, because retail does have the profile of being stickier, as we call it, and investing through a cycle. So last year, 2014, was definitely the year of the borrower, where we invested into the funnel and the credit model and making sure that the business model worked from an economic standpoint. This year, we have hired a dedicated investor services product manager in our product group, which is the people who sit between business and engineering to design new products and services. And he's actually been with us for over 6 months designing the future of the investor experience. So over the next 12 months, we have a roadmap to not only rebuild what we call the investor funnel, which is the process of creating a new investor account. We think it needs a lot of work. It could be a lot easier, integrating with services like PayPal for funding, but also to rebuild the tools that investors have access to, and to screen loans, to buy loans, to look at their performance, and to gauge how they're doing on the platform. Some examples, literally would be, making the API work faster, work better. One of the things I'd like to see actually is the ability for someone to come on the platform and just say, just index me, just buy me a representative sample of everything that comes across, so I don't have to, do this complicated screen, this criteria screen. Mm-hmm. And so we're, rebuilding AQI. We're, rebuilding the web screening experience. We're rebuilding basically everything. We're also looking at rebuilding the folio experience, although I think we need to do some work just getting it up to par. I mean, I will be the first to acknowledge that, the investor side of the house does need that work. And so we have a weekly, what we call a scrum, where we all sit down and we talk about priorities and development schedules and rollouts for investor services. You'll really see the first fruits of that labor rolling out onto the website in the beginning of the second quarter. We're doing the development work now. But I'll also say that, from my perspective, the future of the business, the holy grail for me with regards to retail participation and broad-based retail participation, may not be directly related to people who are coming to our site.
Mm-hmm, for sure.
I think that, what we have as a website where investors seek us out, they understand what we're doing, they understand the product, and they want to transfer money to us and open an account and start picking loans, is still a hobbyist or an expert experience. And it's great. That's our bleeding edge. Those are the people who represent the core of our business. But if you really want to get out there and get broad-based exposure, you really have to create a vehicle that people can just say, hey, I want to have exposure to this asset class. And they go into their Schwab or their Fidelity or their whatever brokerage account, and they buy a ticker. And that ticker basically buys them an index of Prosper loans.
Right.
And
I completely agree.
I would say that we are actually working with third parties. This is not something that we would do. We're not an investment platform, but we are working with third parties who are exploring creating sort of closed-end fund structures that would literally be like an ETF or a closed-end mutual fund that would allow people to just buy a ticker, an exchange-traded product, and get exposure to the asset class. And for me, that's really when you're off to the races from a permanent capital retail perspective.
Yeah, I agree. I think having individuals open up an account, you need to be more of an enthusiast to really do that. I mean, the way that the majority of people, if this industry is really going to get the scale that we think it will, people need to be able to select it as part of like their 401k plan at work and be able to say, right, that sounds great. I'll give me some unsecured consumer loans and be done with it. I think that's the key. So yeah, it's point taken.
Well, also, if you think about it, Peter, like what wealth manager or RIA is going to say, yeah, you should transfer assets off of our platform to that website and buy loans, go and pick loans in an active way. If we actually had that exchange-traded product, the wealth manager could say, hey, leave your money here on our platform, buy this vehicle, this low overhead expense vehicle, and have a 5% allocation from your fixed income portfolio to unsecured consumer loans. That's the way it's going to have to be. I mean, right. You're not going to get broad-based appeal for people opening up individual accounts.
Yep, for sure. So I want to switch gears a little and talk about a couple of recent developments that really just happening this month. And the first is a change in your reporting. You're going from real-time daily updates of your loan numbers to doing it quarterly, 45 days after the end of the quarter. I wanted to get your reasoning for that and the timing of the change and why you decided that was important.
Sure. There's multiple aspects to the conversation around data and how we disclose. Their details are on the Prosper blog of exactly what we did. But fundamentally, all of the moves are the move that we made is really designed to do two things. They're designed to preserve bidders and customers access to bidding data. So if you're an API user, if you're looking at loans on the website, individual loan criteria is all still there the way it's always been. And investors will also continue to have access to their performance data on a loan-by-loan basis. What we've done is we've removed some of the files that give you the whole picture of everything, every loan we're doing by loan ID, cross-reference with credit criteria. And why we're doing that is to protect our most valuable asset, which is our data asset around underwriting. There have been rumors and there have been actual products that have been released by people who have literally gone out and pulled down our data and either tried to reverse engineer it or reverse engineer it to launch their products and to get a jump start on data.
Yep. Some of them have told me they've done that exact thing for both you guys and lending clubs. So
and by the way, it's actually illegal. It's a total violation of the terms of use. Everybody who actually gets access to our data signs a confidentiality agreement. People are doing it anyway. There are bad actors in the industry. Those people are actually making probably a really big mistake by thinking that they can just use technology to reverse engineer a credit model without actually having the expertise in-house. This is hard. This is, we have statisticians and mathematicians here that are actually looking at this stuff and tweaking it every day. But fundamentally, what we're trying to do is we're trying to just protect that asset. It's our proprietary data. It's information about our borrowers, and it is our underwriting model. And so we're just taking it off the open internet and protecting it so that we can preserve value in the organization. And then the other aspect really is on the reporting of the loan volumes and stuff, which is very similar to what we've seen others in the industry do. But we want to be and we want to get others to focus on quarterly results. We want to have the appropriate time horizon for investment and growth. And we don't think that people should be focusing on us on a day-by-day, month-by-month basis. There's variations in the business. And so, we're going to just get into that quarterly reporting schedule now. If anything ever happened with this business in the future regarding going public or an acquisition or anything else, that would happen anyway. And it's just a change in sort of the longstanding way that we've reported it, like literally on a day-to-day basis. And it's to protect us from those short-term wins. I mean, we're a private company. We need to have the freedom to experiment and to fail, to miss a month, to hit a month, but we want to keep hitting our quarters. And so this is just about, again, controlling the reporting data. We report our finances on a quarterly basis anyway. We're just putting the originations on the same cadence.
Right. Okay. Well, I'm gonna get to that IPO question that you just threw out there in a second. But before I do, I want to go back to the other big piece of news that just happened, and that is your acquisition, the first acquisition in Prosper's history of American healthcare lending. Can you I guess give us a bit of the backstory to how they got on your radar and why you decided to make this acquisition?
Yeah, well, this is something we're very excited about, Peter, and I'm glad you asked about it. We've been working with American Healthcare Lending for a while now. They're actually one of our partners. They basically do what is called financing as a service. They are in a large number of doctors' offices around the country, and they focus on helping patients arrange financing for elective medical procedures. So if you are at a fertility clinic that is a subscriber to AHL's service, they will, literally hook you up with a Prosper or one of the other providers on their platform and make sure that you get the financing to get that done. Again, we've been partnered with them for a while, and we see this as a really exciting opportunity for Prosper to expand our capabilities into the point of sale and elective medical space. So, if you think about it, right now our marketing efforts really are directed either through direct mail or partnerships, sort of for a direct response, direct to consumer, so B2C type of contact.
Mm-hmm.
And AHL, their elective health offering is a B2B2C model. So they're basically going from Prosper to AHL to the doctor's office. The doctor is then trained to make the offer of credit to the customer, and the customer can apply when they need the credit. And this is a capability, a sales capability that we're interested in owning and continuing to build. And we think that the elective health space is the perfect place to start. It is a $20 billion a year origination market, growing at about 20% a year. And the thesis that we have here internally is that it's actually going to grow faster than that, and that there's also an opportunity, a wild card here for increased growth, where if you see, more and more Americans with healthcare plans with high deductibles, $5,000 to $10,000 deductibles, there is room for a Prosper type loan to help them actually pay off even covered procedures.
Right.
And so, we're acquiring those guys right here in January. The deal's actually closed. And it's going to be business as usual for them for a while, but this is really, part of our strategy for 2015 is the capabilities building so we can broaden our reach going forward.
Right. So practically speaking, you said these are already a partner of you guys. So that you are already obtaining new borrowers through this channel. So I guess nothing's going to change dramatically, I guess, as you integrate this, because you're still going to be a channel partner. I mean, I presume.
Right. Sorry, Peter. Sorry to interrupt. We're really gonna. This is capabilities for us. We're not buying growth. We're buying technology. We're buying sales acumen, and we're buying a channel. And so it's a little bit different. You're not going to see like us, tack on a new segment of originations that we weren't doing before. We are going to integrate the business. We are going to change the business model a little bit into a real competitive point of sale product, which will allow us to offer the Prosper loans directly in the doctor's office with potentially competitive rates and competitive terms to the other products that are in the elective medical industry. But we really feel like elective medical is a space that's ripe for disruption. There are a number of players in the space, and they are sort of operated without very much competition and very wide spreads over the last number of years. And the rates are high. It's very much like the credit card business, where the rates are high. There's teaser rates with back interest if you don't pay. And we feel like a consumer-friendly, high-touch customer service experience like what Prosper has to offer could be potentially extremely disruptive to the elective medical procedure. Sure,
and as you said, even the broader medical. I mean, I know that so many people now have a $5,000 or a $10,000 deductible on their plans. It's because it's getting so expensive. So I can see this broadening dramatically. I wanted to go back to you threw out the IPO comment. There's certainly been a lot of speculation since Lending Club went public a little while ago. I get asked this, I'm sure you get asked this every day, just about what are your plans? Is an IPO on the horizon for this year, for next year, or what can you talk about it?
Sure. So, as you know, Peter, it's difficult for me to make forward-looking statements with regards to anything like that. I'll tell you, we don't currently have a plan for going public, and we haven't hired an underwriter or filed an S1. And frankly, the good news for the public is if we ever do file, because of our unique structure, we cannot do a confidential filing, so it'll be telegraphed way ahead of time. Mm-hmm. No, but we are. Look, we get a lot of utility out of being a private company. Like I said before, we want to be able to make investments. We want to be able to succeed or fail, and have variability in our months if we want to experiment with new projects. At the same time, we are getting big. We are growing fast. The macro environment is pretty good. Never say never, but there's like I said, there's currently no plan in the works right now.
Okay, I guess that's the best we can get from you on that. The other thing I wanted to talk about briefly was, your previous company was acquired by Wells Fargo, who are active in the space in one capacity or another. I mean, Norwest Ventures was a big investor in Lending Club. I mean, I think you guys have Wells Fargo. I mean, the cash accounts that we have as investors sits at Wells Fargo, and you obviously know this company. I mean, you work for them for a few months. Where do you think a company like Wells Fargo actually becomes, more active in the space? I mean, do you think a company like Wells Fargo would ever acquire you or take a majority interest? I mean, what are your thoughts on the large banks like that?
Sure. I have a huge amount of respect for Wells Fargo. I only worked there for about 6 months, so put that into perspective. But
right.
So I don't know them as well as I probably could, other than that, they're really great people and it's a quality organization. We do have our corporate banking is there, and when you open an account at Prosper, that's where the money actually is held, right? Mm-hmm. So they're our bank partner,
right?
And I do know, the individual who was leading the group that purchased Merlin is now the CFO of the entire bank, and I've actually sat down and had conversations with him about their view on the world. Look, I think the big banks fundamentally are, they're pretty frustrated. They are operating in a very strict regulatory environment. And they've spent the last, 7-8 years convincing the regulators that they need to underwrite loans in a certain way to a certain level of quality with a certain amount of overhead, that they can't just go back and say, hey, you know what, we were just kidding. We want to do the also unsecured consumer credit under $100,000 and do it all online like Prosper does. I think that they just don't want to deal with the regulatory scrutiny right now, given what they're under. And I think the opportunity for them relative to the things that actually are the cash cows and make them a lot of money is very small. So, there are a number of banks that actually do have term loan products in their offering, but it's kind of like number 19 on a list of 20 things that they want to sell to you. And I challenge you to try to find those things on their websites, or you have to go in and apply for it in the branch. I just think it's not unsecured consumer credit under $100,000 is not an area of focus. I think they perceive the regulatory risk as too high. I think the cost structure for them with the branch model is also too high. We can underwrite our loans for a cost that is just not in the realm of possibility for banks where they are now, given their structure. And so in terms of a competitive offering from large banks, you may or may not see it. I mean, you may see term loans, but I don't think you could see a peer-to-peer offering from a large bank. And I think the opportunity actually to work with these guys is actually in partnership with some of the regional, super regionals, and some of the community banks as well, where they don't have underwriting. They don't have the expertise, the wherewithal to extend credit to their current customer base, where we can work with them and try to help them with a lending program of their own. Mm-hmm. I don't see Wells Fargo also being able to go to their current shareholders and saying, hey, we want to acquire one of these businesses at a large valuation and then roll it into their business, which is valued by a book multiple. I just don't think that's in the cards.
Right. Yeah, that makes sense. So final question. I know we've gone over time here, but I really want to ask you a little bit about the growth plans. I mean, you've really focused on unsecured consumer credit for, basically from day one. What about moving into other areas? I mean, going down the credit spectrum, maybe moving into small business or auto, or what are the plans? What are you thinking about to help grow this business over the next year to 3 years?
Sure. So I think one of the things you're going to see as a point of strategic differentiation for Prosper is that we intend for the foreseeable future to remain focused on unsecured consumer credit. I fundamentally believe that going into small business lending or mortgages and other types of secured lending or different underwriting models, each one of those represents a new business with new underwriting criteria, with new data requirements, new areas of expertise, new marketing channels. It's basically starting a new company, and I think it's fraught with risk. What we really want to do is we want to focus on, exploiting the data asset that we have and that we've just taken steps to protect, and being the player for unsecured consumer credit. That means expanding out from 3 and 5 year loans for debt consolidation, which is predominantly what the loans have been used for to date, and getting into new channels and new use cases, for example, like elective medical, like home improvement, special occasions, even small business, but I would only say small business in the way that entrepreneurs would use a Prosper loan to start their business as opposed to their credit card, because part of the thesis we have around here is that credit cards are a fantastic transaction medium. They're in your pocket, they work at the point of sale, and they're kind of everywhere. They're ubiquitous, but they are a bad way to borrow money for more than 30 days. And that we really need to get out there and we need to educate people as to what we're doing and create broader use case for the term loan product. And if that education, understanding, and awareness is there, then this market, you move from the $800 billion a year credit card market to the $3.3 trillion unsecured consumer credit market, and you build the capabilities around point of sale finance and transaction finance and be there when people actually want to make a transaction and borrow for that transaction. And that's really the future for Prosper. So we'll continue to build out product functionality, product features, and capabilities. We're going to be spending this year in brand building. So sometime around Lend It, hopefully we'll see a new brand identity. We'll be in greater offline channels like television, radio, terrestrial radio. We'll continue in Sirius XM. We're going to hone our message, and really the goal is to create a nationally recognized brand at the end of the year. We have a new CMO with pretty deep e-commerce experience and marketing chops to help us do that. And we're gonna press our expertise and really stay the focused player in the industry on consumer credit. We will likely be deeper in the credit spectrum as we do with capabilities building. If we're going to do the point of sale finance and the elective medical stuff, we probably have to have the data around people with lower credit than 640 FICO. But it probably won't be an excessively large area of the business for us, given that it doesn't really represent a huge payoff for us from a business model perspective. Mm-hmm. It's really just more capabilities building. So if you think about if we were down to 600 FICO, those loans are inherently smaller based on the way, our loans are based on an individual's ability to repay. And so the payment needs to make sense for that person. So the loans are inherently smaller. The fees we can charge are thereby even smaller. And they don't even really make a ton of sense on from a marketing perspective and recouping our costs. Mm-hmm. And so we're the opposite of a traditional lender in that respect, where you see those guys rushing into subprime to do more and more because the rates are higher and they can make a ton of money on it. We make the lion's share of our money on our B, A, and AA loans, but we do have to have that broader set of capabilities to penetrate the markets more deeply.
Right. Okay. Great. Well, on that note, I think we'll sign off. I really appreciate your time today, Aaron.
Thank you, Peter. It's a pleasure.
Okay. Thanks a lot. Bye.
All right. Bye.
Well, there you have it. It's certainly interesting that Prosper is choosing to focus just on the consumer credit market. That it's certainly a big market, and I can see their reasons for doing so, and it's certainly a way for them to differentiate themselves in this industry. And as much as I would have loved to have heard a secret about any IPO plans, I obviously didn't expect to. And, I said in my predictions post earlier this year that I didn't think Prosper would IPO this year. Now, that may or may not end up being accurate, but I wouldn't be surprised if they use this year to really, consolidate what they've done and really focus on their business. And, going through an IPO is a bit of a distraction to the core business of any company. And so I think we may still not see that until 2016. Anyway, on that note, I will sign off. Thank you very much for listening, and we'll catch you next time. Bye.